Good morning, everyone, and welcome to NYSE TV Live. I'm Kristen Scholler, coming to you from our studio above the iconic trading floor. And as we embark on the fourth quarter trade, investors have shown resilience despite rising tensions in the Middle East. We see stocks set to open fractionally lower when we do hear that bell in just about 30 minutes time after ending little changed on Wednesday. Well, still, markets sit near record highs, and the Federal Reserve is preparing further interest rate cuts to come, with companies also coming to market. Now, in fact, today, FrontView REIT is going to ring the opening bell to celebrate its IPO. The REIT officially debuted on the stock exchange yesterday, pricing its deal in the middle of the range and raising about $250 million at a valuation of more than $500 million. It joined Standard Aero in opening shares yesterday for the first time, and Standard Aero was the third biggest IPO that we've seen this year. Maybe an even better stat, it was the first billion-dollar IPO to price above its range since the 2021 IPO boom. This surely seems to be a sign that investor sentiment is strong, consistent with what we've seen across other data points. Well, over this next hour, we'll be covering FrontView's celebration along with a slew of other major headlines. And as we always do, we'll dive into how ongoing storylines like this conflict in the Middle East are impacting markets, as well as what investors are anticipating when it comes to the September jobs report out before the market opens tomorrow on Friday. Now, when it comes to the conflict between Iran and Israel, Eurasia Group President Ian Bremmer is going to join me to break down the situation and offer his insight into what might happen next. Well, with FrontView REIT taking to the podium in less than a half hour for that opening bell, we will explore the commercial real estate industry and how the firm is adapting to the latest trends. Well, positioned at the epicenter of the global financial markets, traders here at the stock exchange are tuned into what's happening overseas. President Joe Biden said yesterday he will not support an Israeli attack on Iran's nuclear sites. And his remarks come after Iran fired about 200 ballistic missiles at Israel on Tuesday, following the killing of a Hamas leader in Lebanon. Well, tensions rise in the Middle East. I want to bring in Joe Brusuelas. He is a principal and chief economist at RSM to talk to us about the economic impact, of course, mostly here at home, but how these events all impact it. Joe, thank you so much for joining.
Thank you. It's good to be here at the iconic New York Stock Exchange.
We're so happy to have you. And I actually want to start this morning with jobless claims because we got that data before the market opened. You and I were talking about it a little bit more than expected. What might this tell us about the labor market?
I think what it tells us is that job security for Americans is really at an all-time high. You know, the pace of firing, those initial claims have been remarkably stable now for a long period of time. But a little bit of seasonal noise that we always see in June and July that then backed off, right? So we overshot to the downside. It was 219 last week, it's 225 this week. Now, the 13-week moving average, which is how the pros on Wall Street look at jobless claims to smooth out that sort of noise, sitting around 235. So you can expect a modest migration upward in claims, but really that's about it. I think what's really important to remember too, the Boeing strike is not showing up in the claims data. Striking workers can't file for jobless claims, but those who are impacted, say in the aerospace ecosystem or the localities, they can. And we're just not seeing that quite yet. It gives you a good idea of just how resilient the American economy is at this time.
Interesting. And of course, this weekly jobless claims data that we get routine Thursday morning before the bell does come before that September jobs report that's out tomorrow morning. What are your expectations when it comes to the non-farm payroll report?
So we're expecting a net change in total employment of 120,000 with risk of a much more brisk print, a little bit stronger, 4.2% on the unemployment rate, 0.3% increase in average hourly earnings, which should translate to around a 3.7% overall year-over-year increase. So we think that this is what full employment looks like. You know, it's important to remember that when you're at full employment, we got an economy that's growing a little over 3%, I think, through the third quarter of the year.
Yep.
We've got productivity now really gaining some traction, 2.7% year over year. Firms just don't have to hire as many people, right? They're going to be more interested in controlling costs because, as we can see, And we do expect in the third quarter earnings, which we'll be getting here in a couple of weeks.
That's right.
That you're going to see profits broaden out. It's not just going to be about tech. You're going to see the other sectors really begin to look a lot better, improve net earnings, improve revenues, improve profits. It's one of the reasons why I'm bullish on risk assets heading into the end of the year.
Interesting. And of course, for our viewers watching at home, those risk assets mean stocks, right?
Yeah,
Here at
they
the
do,
stock
yeah.
exchange. So I'm curious, Joe, based on what we see from the Fed, half a percentage point interest rate cut at its latest meeting, mid-September, forecasting about the same before we get to the end of the year. Does this data indicate another half of a percentage point cut to you, or perhaps 2 quarter cuts before year end?
So Jay Powell last week gave a very interesting speech before the National Association of Business Economists. This data supports what Powell was pointing towards, which is not a 50 basis point cut, but a 25 basis point cut in November and then another one in December. So we will have seen a complete full 1% or 100 basis points decline in the federal funds rate between the time the Fed started their rate cutting campaign and the end of the year. You know, we've seen some very strong data. Now, last week, we saw upward revision of $294 billion to GDP. Let me put a framework around that. Essentially, we added somewhere between an entire Finland economy or Chilean economy to ours just over the past couple of years. And here's what's really important if you're managing portfolios. $800 billion in extra income was discovered, primarily in interest and dividends. What that means is there's a lot more cash out there. And it's, again, one of the reasons why, just from a very fundamental basis, I'm quite bullish. I think we had a constructive and encouraging outlook on risk assets. And I think once we get through the noise caused by what's going on in the Middle East, and hopefully we can get an equitable solution to the port worker strike, we're going to be in a very good position.
So let's talk about then what we do see unfolding in the Middle East, and certainly some uncertainty impacting stocks this week. Believe it or not, speaking to the resilience, we've seen the markets hold up pretty well based on what's been unfolding there. Do you expect that that could impact the U.S. economy?
Okay, so financial markets have been extremely well behaved during the first few days of this. Of course, there's a geopolitical risk premium attached to the price of oil. You're going to have Ian Bremmer on, who's fantastic, and he'll talk about, power politics and geonomics and how the intersection of that can spill over and had some adverse effects. But look, we had a lot of oil sloshing around the global economy. Chinese demand is diminished at best. And you know what? The U.S. economy is energy independent. We produce 13.2 to 13.3 million barrels per day. We expect that to increase over 14 million over the next 12 to 18 months. You've got other non-OPEC producers really increasing their overall supply. U.S. sits adjacent to Mexico and Canada, pretty notable oil producers. Moreover, we've seen an all-time high in the increase of production of natural gas, and we're diversifying away. We're developing renewables. Let me give you an example about that. I live in Austin, Texas. 2 years ago, my wife and I built a house, and she wanted a great big tall roof because it reminded her of what it looked like here at home on the Upper West Side. So, sure, right? My brother was like, "What are you doing? You're going to pay for this?" I'm like, "No. Half of energy in that part of Texas is produced by renewables. Energy is incredibly affordable because of that diversification." To make the long story short, even when we get those geopolitical disturbances out of the Middle East, the United States is far less exposed to it than it was 10 or even 20 years ago. And again, that's why you're seeing financial markets be so well behaved here.
Right. Those stocks still near record highs ahead of that jobs report tomorrow. So, Joe, I'm going to end. We just have about 30 seconds left in terms of what this strike means. What is its impact?
0.1% each week it goes on. 4.3 billion taken away. Lots of inventories were brought forward over the last 2 quarters. So there's enough inventory out there to get us through 2 to 4 weeks. We won't even see the economic impact of this probably for another 45 days.
Okay. Joe Brusuelas, thank you so much for joining. Appreciate it.
Thank you.
Here in our studio above the iconic trading floor. Well, we are just getting started here on NYSE TV Live, and stay with us because up next we'll be speaking with a commercial real estate agent who's going to reveal how the industry has changed since the pandemic ahead of this real estate opening bell.
thanks for joining me on Floor Talk today.
I'm so glad to be here.
So, Kurt, dating back to the mid-1920s, there were as many as 25,000 banks. Today, there are about 4,500 banks. How has Comerica survived in this ever-changing environment for 175 years?
Well, Judy, we are celebrating our 175th anniversary, if you just referenced, and we were founded in 1849. We're actually the 41st longest tenured company that's traded on the New York Stock Exchange today. We're very proud of that history. But I think a few things for us have been unwavering throughout that time. One has been our commitment to our employees, our customers, our communities that we serve. We've always had a conservative approach to banking in general, and we've always had a strong financial position. We operate in some really great markets. I think all those things combined has allowed us to survive and thrive through lots of different changes in the world and in the United States over that period of time.
Now, you're ringing the closing bell today to celebrate your 175th anniversary, so congratulations on that amazing milestone.
It'll be great.
Now, tell me, how are you different from other regional banks?
Well, part of our orientation as a bank is really strong around commercial and C&I banking. About 80% of what we do is in that area of commercial banking. But we also have really strong retail and wealth management capabilities as well. We operate in a lot of great geographies, some of the most major metro areas in the United States, the Southeast, Texas, California, the Midwest. And really beyond that, I would say just our relationship focus. We've got very long tenured bankers, very long tenured customer relationships. And we like to think of ourselves as a bank that delivers all the capabilities of a really large bank, but we can do it in much more of a personal way, much more like a community bank.
Welcome back to NYSE TV Live, everyone. I'm Kristen Scholler. And now to dive more into the shifting market dynamics, even the trends driving demand in commercial real estate, I do want to bring in my colleague, Trinity Chavez, with more. Trinity.
Thanks so much, Kristen. Yeah, so from navigating New York's bustling streets to closing deals in some of the city's most coveted spaces, Jade Shanker is redefining what it means to make a mark in commercial real estate. And she's also a star on Ryan Serhant's hit show, Owning New York. And she's bringing her unique blend of socialite connections and business savvy to the big screen. And she is joining us now in studio. Jade, it's great to have you. Thanks for joining us today.
Thank you so much for having me, Trinity.
So, you've been in the real estate business basically your whole life. Your dad, you were born into a developer family. Mm-hmm. Your dad was one of the original investors in the East Village in New York City. Talk to me about that, but how also you've seen the real estate sector change so much.
It's kind of crazy because right now is sort of like we see the same economy that we did back in the 70s where buildings that were once transacting at a much higher price point are now discounted up to sometimes like 60% of the market value. Mm-hmm. So really savvy investors are seeing the opportunity and they're like, you know what, New York is super safe, and if I can withstand the storm, I can make money. And we're keeping track of the overall leasing activity because when it comes down to it, like if you can buy low and sustain and create a different marketing strategy, you can typically make the investment make sense for you.
But tell our viewers and myself exactly what are the different trends right now that you're seeing in the commercial real estate sector as opposed to traditional real estate?
Well, I think one of the interesting things that happened in a post-COVID world is everything went remote. Yeah. So companies that weren't able to adapt, unfortunately went under. So we're seeing a massive change when it comes to both consumerism, that is both international and people who are, focusing on e-commerce, and then using the space as more of a way to downgrade their footprint, but also be in one of, I think, the U.S.'s like prime locations. Yes. So they're taking advantage of the price point because it is like pretty low. And then also like from the owner side, I think a lot of people are using the marketing techniques to not just connect with owners locally, but, utilizing marketing and really pushing it out to get an international presence, to get more owner users who are utilizing the space.
But now as more businesses are basically mandating their employees now to come back to the office, we're seeing a lot of people returning back to the office. Mm-hmm. So talk to me about how that shift has impacted commercial real estate.
So at first it was tough.
Yeah.
prices were pretty low, but what happens is when prices are low, people see opportunity.
Yeah.
And it's almost like a giant Black Friday sale where we see more companies who were able to adapt and they were able to manage their finances, and they're kind of taking advantage of the opportunity they're coming, and they're like, you know what, let me come in and let me find more spaces, because overall supply has gone up, prices have gone down. So we're seeing companies, even LVMH just took over 150,000 square feet of office space. Giovanni took over 121,000 square feet in right on Bowery. So people are utilizing the space. It's more owner users who are coming in, and rather than leasing a space, they see an opportunity in purchasing.
And it's interesting. You just you just named a few brands, right? Retail space.
Yeah.
However, what are other companies that you are noticing that are really investing in the commercial real estate space right now? Is it just retail, or are we seeing, banking institutions or direct-to-consumer businesses?
Yeah, a lot of financial institutions are seeing the same things that us, like on the floor, are seeing, because they're seeing like the lower price points, and a lot of also like smaller investors are coming in, and because they're a little bit more niche to New York, they know the market, they know that we're gonna see recovery. I would say in the next like 12 to 18 months is when we're gonna see an upward turn. So people are like taking advantage of the space. So yes, financial institutions, CBRE just closed a massive deal right on Fifth Avenue. So we're seeing a lot in mostly, I would say, the lower Manhattan market below 57th Street.
Who are mostly your clients?
I would say mostly the younger developer who's niche to New York. So people who are understanding the market as far as, people coming in, and, I would say less international and more people who are niche to New York because they understand the opportunity.
And quickly, you are on the hit show Owning New York with Ryan Serhant. So talk to me about what we can expect for season 2.
Okay, well, I can't say too much, but all I can say is there is a lot going on in each of our lives. You guys saw the most insane points of the show when it comes to the personal life, the deals, and what's really amazing is, again, like as I said before, in a post-COVID world, we have to adapt. Whether you're an institution and you're utilizing Zoom and work from home and adapting, we're also seeing it with marketing techniques. And I think the old brick and mortar way of trying to sell a building just doesn't necessarily work in the best interest for all parties. So it's going to be a lot of more marketing techniques. You guys saw the music video, you guys saw, the launch party. So, that
actually brings me to a very quick question I have, because we have about 45 seconds left. Talk to me about how your marketing strategy has shifted throughout the transition of the commercial real estate sector as we're seeing prices drop.
I'm very niche to a certain market, so I understand. I have the time to look at each building and say, I can understand the target demographic for this, and I, focus the marketing technique to that building, to the consumer, and overall the trends that we're seeing in, the market space.
Well, I can't wait to see all of this unfold in season 2 of this show, and looking forward to having you back on NYSE TV Live very soon to talk all about it.
Yeah, thank you for having me.
Absolutely, thank you so much, Jade. Well, I'm going to send things back over to my colleague, Kristen Scholler. Kristen?
Trinity, thanks so much. And of course, we'll find Trinity on the floor in just a few moments. But as FrontView REIT, we talk all about real estate, of course, during this show and throughout our time here at the NYSE. As that company prepares to ring the opening bell today, it is worth pointing out that the New York Stock Exchange is no stranger to covering real estate investment trusts. Well, earlier this year, our Judy Shaw sat down with the CEO of the NYSE-listed UMH Properties, Sam Landy, and asked him how his company remains strong after 55 years. Here's what he had to say.
Part of it's the necessity of affordable housing, that manufactured home communities are hard to build, it's hard to replace them, but we've had 55 years experience finding good acquisitions, renovating the communities. We've adjusted to whatever economic conditions we had to adjust to. There was a time it was easy to finance our customers, then that became difficult. We went to rental homes, and we're now renting out 1,000 homes per year.
So now, over the years, you've acquired a lot of properties. Tell me, what's enabled you to be successful with your strategy of buying turnaround properties, making the needed improvements, and how you're able to add value?
Originally, we tried to stay in the same geographic footprint because it was easy management. Pennsylvania, Ohio, Indiana. We specialized in communities near each other because that was very efficient. But after COVID, we sort of discovered how great our business was. As good as we thought it was, it became even better when through COVID we maintained 95% rental home occupancy and 98% collections. And we realized people will do anything in their power to keep this house. They're renting a 1,000 square foot, 3-bedroom, 2-bath house on a 5,000 square foot lot. And even if they lost a job during COVID or couldn't work as a waiter and waitress, they found other jobs and found a way to pay the rent because they didn't want to lose these houses. They have their own driveway, their own shed, no common wall neighbor above, below, beside them. And we realized how desirable our product is and how cost competitive we are, and realized we can go to new locations. So when we went to Dothan, Alabama, originally we might not have gone there because housing's not that expensive in Dothan, but as a rental product, we're competitive against any other form of housing, and we started to geographically move, and that's worked incredibly well.
As a manufacturing housing REIT, you benefit from having access to financing with the GSEs. How has this benefited your business, and how has this environment evolved over the past few years?
Well, just this past year, we were carrying over 1,000 homes in inventory, which is about $70 million. And the interest rate on that's about 8%, so it costs us $5.6 million. When we rent that inventory out and it's earning money, we can refinance the communities with the GSEs and reduce our interest rates to below 6%. And that savings gets passed on to our residents and becomes dividend to our shareholders, which creates additional investment to build additional affordable housing throughout the country. So the GSEs, and we want to thank HUD Secretary Fudge, Wells Fargo, the people at Fannie Mae. They've recognized there's a duty to serve the people who need affordable housing, and they do it through UMH and our quality homes and communities.
And finally, Sam, what is UMH doing to solve the shortage of affordable housing?
Well, exactly. So many people don't even really know that manufactured housing is the great alternative. People only need $40,000 per year household income to afford the houses we rent. And so we need additional locations. We need to spread out to additional states. We need employers to know that there's a great alternative for their workforce, that if you want the wages you pay your employees to become more meaningful, you need UMH to build a community near you, because when we're right next to the warehouse, and you can see us next to warehouses in the drone videos at umh.com and umh.REIT, and you'll see that we build our communities right next to businesses. The business takes advantage of the affordable housing, making the wages they pay to their employees more useful for housing and other things they want. So we need to build more communities. We need to work with the GSEs to create better financing, and we need to just keep spreading awareness that this product exists.
All right, we are just less than 10 minutes away from the opening bell. Stay with us. We'll see you on the other side.
Joshua Weinstein is the co-founder of Sonora Global Media, and it's the fastest growing Hispanic media company in the world. Sonora produces over 150 audio-first content pieces, transforming them into TV properties, films, and live experiences. And we're covering it all on this episode of Taking Stock. Sonora has quickly become the fastest growing Hispanic media company in the world. What would you say have been the key strategies to help you achieve such success?
Today, there's nearly 70 million US Hispanics here in this country and over 500 million people who speak Spanish globally. Our focus is on where culture and commerce are going, and it happens that US Hispanics are driving culture and commerce. Whether that's music, whether that's art, whether that is spending patterns, what we're seeing is growth in this country is going to be driven by this particular demographic, and we want want to super serve them with content that matters and that really speaks to the community. Our idea was to start with audio first content, and that is allowing us to develop content rapidly, inexpensively, and in a scalable manner. Today's Sonora will deliver more than 70 million downloads this month. And we're able to reach more than 1 of 3 US Hispanics. What enables us to do that is the experimentation that comes from the audio format. So the RSS feed, the way that you get podcasts delivered to your phone, allow us to have almost zero marginal cost of distribution, which means a small startup like us can have the reach that would be otherwise prohibitive in earlier times in the media landscape.
Why did you choose to focus on strictly Hispanic audiences?
Our view is that US Hispanic consumers and Spanish speakers globally are misunderstood and disrespected. And that represents not only an opportunity from sort of a DEI perspective and whatnot, but also in terms of where culture and commerce are going. And so when you think about the global spend of the US Hispanic, which exceeds $1.3 trillion, our view is that a lot of money is being left on the table.
What sort of opportunity? Welcome back to NYSE TV Live. I'm Trinity Chavez, and if you're just joining us, FrontView is making waves in the commercial real estate space with diverse portfolio of over 2.1 million square feet across 208 properties, focusing on high visibility, out parcel locations, and we're going to talk about all of that and so much more with Ron Bullard. He is the real estate lead for the New York Stock Exchange. Ron, good morning.
Good morning, Trinity. How are you today?
It's great. I mean, we've had a very strong year. Talk to me about what has been driving the market surge that we have been seeing so far.
Sure. So we've seen the S&P up about 20% year to date. We've had an extra 5% of gains in Q3 alone. But when you look at that, it's not really a great sense of the broad market. It's been a handful of very highly weighted stocks that have driven a lot of this outperformance, particularly in the information services sector, IT, a lot of things that are focused on AI have been driving that broad market rally to put those 20% gains in on the S&P.
And you know, in addition to the S&P, what other metric could be used to really measure a better view of the market, would you say?
Sure. So the S&P is a weighted index, so larger stocks get a bigger weighting. You can look at the S&P equal weight, which gives each stock a similar amount of value within that index. The Russell 2000, a great cross-section of some small to mid-cap names, which fortunately, we've seen those names rallying a little bit and broadening out that big rally.
Talk to me about the biggest market shifts that we have seen and dynamic changes that have, as we move to the third quarter and into the second year.
Sure. So in the first half of the year, I had mentioned that outperformance from a handful of names that drew a lot of that really strong rally in the S&P. In the last quarter, we've seen some more yield-driven instruments, some dividend plays, mainly the REITs, the real estate sector, and the utilities that have each seen about 15% gains in Q3 and helping to buoy the broader market. While we haven't seen a pullback in the IT names and some of the big tech names, they've held their gains, which has made for a really strong year so far.
What do you think has really driven the recent outperformance that we are seeing in the real estate sector overall?
Sure. So one of the biggest plays, seeing as they're dividend instruments. So as rates go down a little bit, their stocks seem a little more attractive because they yield more. So it's not surprising that with the Fed cutting, which was a fairly surprising 50 basis points just a couple of weeks ago, we saw a rally in these two sectors. And then looking ahead, a lot of the positioning from Fed officials is calling for another at least quarter to 50 basis points, in some extreme cases 75 basis points of cuts from now until year end, which is only going to serve to benefit these two sectors even more.
Now, with FrontView joining the NYSE listed community of over 2,400 listed companies, talk to me about some of the resources that we offer to this company, but also the broader REIT community.
So they will be adding to our 165 REIT companies at the New York Stock Exchange. It's over $1.5 trillion in market cap alone. And each year we like to look at, this is day one for their company, but we like to deliver value every day to listed companies going forward. And a couple of ways we do that for the REIT space. Every year in June, we host what's called our REIT Investor Relations Symposium, a way to bring together these folks to share ideas. Today, we're going to be hosting a REIT board member forum with Deloitte to help educate board members and talk about critical issues and pivotal things affecting board governance.
A lot of important things to look out for in this space, and you're doing so much to be a part of it. Thank you so much, Ron.
Thank you.
Now we're just about 7 seconds from opening up the U.S. equity market, so let's tune into that, and we'll be right back.
Joining me today on NYSE Floor Talk is Amian Soto. He is the CEO and co-founder at Guesty. Amian, it's wonderful to have you here. Thanks for joining me today.
Thanks for having me.
So Amian, I want to talk about the company. Tell me what Guesty is and why did you found the company?
So Guesty is a software company that creates an end-to-end software product for managing short-term rentals at scale and helping property managers do it more efficiently and more automatically.
So talk to me about your customers.
So our customers are actually a big range of anywhere from individual hosts who are just doing it as a side hustle to SMBs who are doing it more professionally, up to enterprise who do it in hundreds to thousands of properties each.
What's your financial status?
We raised about $410 million today. Guesty is close to being profitable. We'll probably be profitable by the end of this year. And we're pretty happy with our growth rates. Even during the last few years, we kept on growing at over 50% year over year.
So you mentioned your growth and your growth rates. So talk to me about the growth strategy. What's your strategy?
Yeah, so there's a lot of fragmentation in the market, and we really believe that there isn't really place for that many tools out there to compete. It's not efficient. A lot of those are very legacy software solutions. So our key growth strategy is just to build the best product out there and focus on our customers. And yet we also do a lot of M&As to help accelerate the market penetration. So we've done 7 M&As to date. Last one was just a month ago. We announced the acquisition of Rentals United, the channel manager in Barcelona that we acquired. And we keep doing more and more of these to accelerate our organic growth.
So is an IPO in your future?
100%. At least I believe so, but
Welcome back to NYSE TV Live, everyone. I'm Kristen Scholler, and we are officially open for trade here at the stock exchange. Well, as we watch tensions in the Middle East rise, concerns about wider damage are mounting. And joining me now to get a deeper grasp on the situation and its impact is Ian Bremer, president of Eurasia Group, a political risk consultancy. Ian, really good to have you this morning. And of course, this coming as Israel warns people to leave southern Lebanon. What is the likely course of action from here in the Middle East?
Well, you may know that about 60,000 Israelis have been evacuated from northern Israel for almost a year now. And that has led to a lot of political pressure inside Israel. They want to get back to their homes. They want to get back to their schools. The school year has started in Israel. And the Prime Minister of Israel and the War Cabinet has made it a principal war aim to get them back. The only way you do that is either a peace deal with Hezbollah, which certainly is not in the cards now that they've started a ground invasion, or you have to roust Hezbollah, get rid of those soldiers, push them back, between 10 and 30 kilometers from the border. And that is what is happening right now. I will tell you that as much as the U.S. and others around the world are calling for a ceasefire, this policy is incredibly popular in Israel itself. Netanyahu and his Likud party are now polling first in the polls among all parties for the first time since well before October 7th.
Interesting. And so where do we go from here as we talk to traders down on the floor of the stock exchange? Ian, they are concerned that tensions could escalate and that there is uncertainty out there, even as the stock market is just looking at fractional losses this morning.
Well, I mean, if they're concerned that tensions could escalate, they're a little late for that because tensions have clearly been escalating over the course of the last months. We are now not just talking about the war in Gaza, but also a war in Lebanon. That is now happening. Israel is bombing Beirut. They have killed Hezbollah's leader, Hassan Nasrallah. It's by far the most powerful non-state military actor in the world. And yet they are a fraction of Israel's capabilities. So from a market perspective, what's interesting here is that Hezbollah just doesn't have any really good options to hit Israel back. I mean, there have been a few Israeli casualties on the ground, I think about 8 deaths so far, but nothing compared to what Hezbollah is facing. Looks like they're going to get destroyed, frankly. Now, the big question for the markets is what happens with Iran. Because if there were an all-out war between Israel and Iran, one that the Americans would come into, then oil prices aren't going to be 75, they're going to be 120, 150. The Straits of Hormuz would be shut down, major refineries would be destroyed, Iranian exports would be stopped. And we'd be in a global recession. By the way, that would probably mean that Trump is much more likely to win election vis-a-vis Kamala Harris. So there's an awful lot to play for were that to happen. It is more possible than it was a week ago, but it is still not the likely outcome. And part of the reason for that is because the Iranian government has been extremely restrained because they don't want to end up in a war that they will lose. And part of it has been because the Americans are working closely with the Israelis to coordinate what the response against Iran will be. And it is true that the Israelis haven't listened very much to the Americans when they've said, please let in humanitarian aid, please don't do a ground war in Rafah, in Gaza. But in this case, it's not just the Americans asking with no fist in the glove. If Israel wants to hit Iran, which is very far away and has hardened targets, they need American military coordination and support. And they aren't going to get it unless they're willing to work and listen to and with the Americans.
Ian, I'd like you to talk a bit more about oil prices, if you can, because for Americans watching and wondering, how does this impact my day-to-day life? Obviously, it's important to be an informed citizen, but they also might see it starting to show up at the gas pump, with gas prices in particular. What can you tell me?
It has been showing up at the gas pump. Prices are a lot lower now than they have been over the past year, and that's because global demand is low. That's because China in particular has been underperforming expectations. And the Saudis and OPEC, watching the United States produce record levels of oil, have decided that they are not going to continue to restrain themselves and their members with quotas, but instead allow production to move. And you've seen from the Saudi OPEC leadership that they are warning that prices could even go down to 50. So that's on the demand and production side. Having said that, the geopolitics have the potential to screw that up. And the major geopolitical issue that would lead to a severe reduction in production and disruption in supply chain would be if we were to see a war break out, a real war, not just 180 missiles launched at Israel that are all shot down and not a single Israeli is killed, but something much bigger than that, where you have, the militaries fighting the militaries and truly critical infrastructure on both sides and more broadly being targeted. There, the Americans and everyone will get hit immediately.
Ian, we are showing images for our viewers watching at home and, of course, on their mobile devices on the go. We are awaiting a first trade bell, a company that celebrated its IPO yesterday here at the stock exchange today, FrontView REIT. So our viewers who can see this trading floor first opening trade bell on the floor, that's what we are awaiting. Ian, we may be taking that sound, but as we await that official celebration, I do want to turn back to the timeline of next steps from here. There's the trade bell. We got it. Of course, we are just about 9 minutes into the start of trade here at the floor of the New York Stock Exchange. We'll be talking more about the real estate investment trust on the other side. But Ian, while I have you, so good to get your take on all of this. And again, I want to go back to what is the timeline that you anticipate of next steps from here?
Well, the Americans are negotiating with the Israelis right now about what a response will look like. You will remember this isn't the first time we've been concerned about Israel versus Iran. There was back in March, April, the Israelis attacked the Iranian embassy in Syria and killed the Iranian military leader, the IRGC, in Syria. And several weeks later, the Iranian response was to launch several hundred drones and missiles against Israel. They warned the Americans through Turkey and Iraq in advance. The missiles were almost all knocked down. About 99% of them were knocked down, and there were no Israeli deaths, no real damage as a consequence. This time around, it was 180 ballistic missiles, which is a lot bigger attack. They warned the Americans hours, not days in advance, and there weren't any deaths, but it was a broader range of targets. And so now we are waiting for what the Israelis, with the Americans, are going to do in response. Now, the Israeli strike back in April hit and damaged an Iranian radar installation. And that radar installation was protecting Iran's nuclear research and development capabilities. That's a clear message from Israel. You do this again, we're not going to hit the radar that's defending it. We're going to hit the nuclear capabilities itself, which are, of course, a crown jewel of Iran's national security capabilities, and also very hard to hit. Some of those facilities are very deep underground, they're hardened, they're under meters of granite, and the Americans would be involved if you're going to be effective there, not just Israel. You'll notice that Biden, just in the last 24 hours, the one warning he gave to Israel is the Americans would not support strikes against Iran's nuclear capabilities, because the Americans understand, just like everyone else, that was the message being sent by Israel. So what I expect will happen will be a fairly broad array of strikes against Iranian military capabilities, not civilians, not government leadership, but military capabilities, maybe some critical infrastructure. It'll happen quickly, and then it'll be over. And then everyone will see how the Iranians respond. My expectation is that the Iranians will say it wasn't a big deal, and that they, of course, have already shown their great capabilities, and we'll move on to the next point. But every time we see one of these escalations, every time we see that deterrence is failing, we get closer to a bigger war. And there are a lot of people in Israel right now that see this as a unique opportunity to really decapitate Iran's capabilities, Iran's military capabilities, the diplomatic capabilities, and maybe even the government leadership. And that, I think, is a big concern. It would be a bigger concern, frankly, if Trump were to be elected president, because his orientation is to support that. He was the guy that ordered the assassination of the Iranian defense leader Qasem Soleimani. And again, you will remember the Iranian response was heated rhetoric, but they didn't do anything. And frankly, that was a much bigger strike against Iran than the Israeli assassination of Hezbollah's leader, Hassan Nasrallah.
Ian, I certainly hope you'll join us again as we see this unfold in the Middle East. And of course, as we do prepare for an election in just about 5 weeks' time here in America. That's Ian Bremmer, president of Eurasia Group. Ian, thanks again.
Good to see you. Yep.
All right, well, let's turn back to that first trade bell. You heard it earlier during my conversation with Ian. That, of course, happened live down here on the floor of the stock exchange. And it's because FrontView REIT is now trading on the stock exchange under the ticker symbol FVR. The company acquires, owns, and manages primarily out-parcel properties. In other words, it oversees the freestanding business or retail buildings that you might see on high-traffic roads adjacent to commercial shopping centers like strip malls. So NYSE-listed companies like Verizon, CVS, AT&T, and Bank of America are among the company's notable tenant brands. And the list of NYSE-listed companies working with FrontView REIT are too many to fit into this particular graphic, but they do include McDonald's, JP Morgan Chase, and Wells Fargo, among many others. So when it comes to industry exposure, FrontView REIT says that it's certain types of restaurants, particularly casual dining and quick service restaurants, are using its business the most. And based on annualized base rent, these two industries make up nearly 37% of the exposure. Automotive stores and dealers, as well as medical and dental providers, each make up at least 10%. Well, overall, FrontView has a more than 2 million square foot portfolio made up of 278 properties across 31 states. And here's a fun fact for you. As of June 30th of this year, FrontView REIT has the biggest footprint in the prairie state of Illinois with 28 properties. Well, stay with us, everyone, because up next, we'll take a deeper dive into this REIT space, what you need to know as an investor. Up next.
Joining me today on NYSE Floor Talk is Lyle Ace. He is the founder and CEO at Verance Capital. Lyle, fantastic to have you here. Thanks for joining me today.
Thanks for having me.
So Lyle, in addition to being the founder and CEO of Verance Capital, you are also the vice chairman of the Houston Dynamo, Major League Soccer Club, and also the Houston Dash. So now tell me,
Now let's talk about Verance Capital. Tell me about Verance Capital. How does your background with these teams play into that, and how are you different from other funds that are out there?
So Verance is one of a few versus a lot of these funds that are LP sports funds. So we're sports, media, and live entertainment, and we're investing in and around the sports ecosystem versus my other day job as vice chairman of the sports teams, which keeps me busy, but we're not investing in teams. We're investing in the picks and shovels around the space.
Okay, so who are some of your notable portfolio companies?
We always get a lot of love when I mention Improbable Media because that's affiliated with Giannis Antetokounmpo, which we're very proud of. Swag Golf is a very cool and interesting company. And then we are in business with John Skipper and Dan Levitard at Meadowlark Media. So those are a few of our more interesting portfolio companies.
Now, there's been such a significant amount of capital flowing into sports over the past few years, and you were an early investor in the sector. Most recently, there's also been an inflection point for women's sports. Is sports large enough to sustain, efficiently direct the capital that's coming into it? What's your perspective on this landscape?
I mean, you hear a lot that sports has become an asset class, and I think that's true from a size perspective.
Now let's shift our focus to the bigger picture of this IPO journey. Joining me to share insights on FrontView REIT and the broader landscape of new listings is Chris Taylor, the Global Head of Listings for the New York Stock Exchange. Chris, thanks for joining us.
My pleasure, Trinity. Good morning, as always. Great to see you.
It's great to see you as always. So let's talk about, from a strategic standpoint, from your vantage point, what sort of strategies do we employ to support the REIT community, specifically when it comes to FrontView?
Yeah, you know, we love the public markets at the New York Stock Exchange. We want to be the champion of the public markets here at the NYSE. The REIT community is really important to the public markets and to the New York Stock Exchange. I mentioned in my remarks to the company, we have 165 real estate investment trusts that are listed on the New York Stock Exchange, valued at more than $1 trillion. So it's a great sector for us. It's a great sector for the economy. We support REITs both directly with the companies. We work with these companies to help them with investor tools so they can communicate with their investors, strategically target new investors. But we also work with their trade organization called NAREIT, which is really, really active in terms of policy that gets set for REITs. And so we work with them closely, both with their financial executives, along with their investor relations executives, as they look to tackle the issues that REITs have and the challenges that they have in the public markets. So really trying to make them as successful as they can be in the public markets is how we address this.
And you know, the NYSE has over 3,000 events every single year, including a REIT event that Ron is going to be hosting later on today. So talk to me more about how, from your vantage point, does the NYSE increase visibility for our real estate companies or companies in the REIT space?
Yeah, well, we do things like we did today with the bell ringing that really gets visibility all around the world. FrontView will be able to take today's visuals and send them out to their investors, send them out to their customers, really make the world know about FrontView all, in a very visible way. But it's the things that we're doing with NAREIT in particular, that's led by Ron Bowler, who leads our REIT business, that really is looking to bring exposure to REITs through the investment community. That's really ultimately what the most important thing we do is.
Amazing. Well, thank you for joining me. I know you have a very busy day ahead of you, so I won't keep you.
Thanks, everyone. Always good to see you. Take care.
Take care. Now I'm going to send things back over to Kristen Scholler. Kristen?
Trinity, thanks so much. That's right. And let's continue this conversation about REITs, real estate investment trusts. To do just that, joining me now is Brad Thomas, the CEO of Wide Moat Research and author of REITs for Dummies. Brad, it's great to have you on the show this morning. And let's just start off by talking about REITs for Dummies. What exactly are REITs? Why do they matter to our viewers?
It's good to see you again today, Kristen. REITs have been around since 1960, so this is not a new asset class. It's been around a long time. But the amazing thing we've seen, Kristen, is over the last decade, many new property sectors that have made their way to the REIT sector. Sectors that you never would have imagined, or at least for me, wouldn't have imagined I'll be covering today, like cell towers and data centers, casinos, and even cannabis. So we're seeing more and more companies, really property sectors, that are making their way to the REIT sector, which is really enhancing the overall broader diversification attributes for REITs. To not only give exposure to individual property sectors like healthcare or multifamily or retail or cannabis, as I mentioned, but also geographic diversification, being able to build a portfolio across many geographies, all 50 states, as well as Europe or international markets as well. So REITs are now a mainstream asset class, Kristen, and every investor should consider owning some percentage of their portfolio in REITs.
I'm curious to know the technicalities, Brad, too, in terms of what dividends usually go along with some of these investments, and additionally, how the interest rate policy set by the Fed impacts them.
Absolutely. So again, REITs have been around since 1960, as I mentioned, and one of the main attributes of this law is that these companies, these real estate companies or landlords, must pay out at least 90% of their taxable income in the form of dividends. In fact, most of these REITs pay out closer to 100% of their net income in taxable income in the form of dividends. So that's really one of the major attributes and what makes this asset class extremely attractive, because of the higher yields. Traditional C corporations, as you know, aren't forced to pay out dividends to investors. They could or they couldn't, but REITs must pay out dividends. So that makes, especially for retirees and people living on fixed incomes, this is extremely attractive for investors because of these dividends. And I might add, one part of our research at White Moat Research is to find companies, not only REITs, but companies that pay dividends that are sustainable. We like to see companies that have durable competitive advantages, and we see that in a lot of the real estate investment trusts, who are able to generate very predictable dividends because they obtain income from a variety of their customers or tenants. And that makes these business models, for the most part, extremely sustainable. Now, there are business models or property sectors that are more challenged, for example, the office sector today. But overall, we're seeing REITs continue to pay out dividends to investors and increase those dividends. And that's extremely important. Now, to your second point, we think the rate environment is extremely important. Of course, we've been waiting on rate cuts for quite a while in the REIT space, and that's one of the reasons REITs have not performed up until lately. So in September, we saw really outperformance in the REIT sector. REITs were up about 3.2% in September and 16.8% in the third quarter. Year to date, 14.2%. So we're now seeing REITs finally catching this rally due to the rate cut, which is lowering the cost of capital for these companies and really, again, increasing their competitive advantages, allowing them to continue to generate dividend growth. And again, that's a key point here. So we do expect to see rates continuing to fall. In November, we'll probably see another quarter, maybe 50 basis points. And again, lowering that cost of capital more for REITs so they can generate wider investment spreads and generate more net income, of course, to deliver that dividend to the end user, which of course is the investor.
Brad, thank you so much for joining. Of course, you were here in March to celebrate the launch of iREIT, which you're a part of. We appreciate the time. He is the CEO of White Moat Research. And stay with us. We'll have much more NYSE TV Live after the break.
Total Expert is a customer engagement platform built for financial services, and the CEO says they win customers for life. We're going to find out how on this episode of Taking Stock.
We are a customer engagement platform that's purpose-built for financial services industry, banking, lending, insurance, really high-value financial transactions.
And what would you say sets it apart from its competitors?
We ultimately, unlike legacy systems that allow institutions to engage based on old data, old information on a customer, we're continuously providing a comprehensive, very rich profile of every customer that allows them to anticipate the needs of those consumers. And what happens when they can anticipate that is they change their sales and marketing processes to be very personalized.
Now, what advice would you have for other executives or leaders who are really thinking about how to improve their whole customer experience?
I think as an organization today, you have to have a mindset of winning lifelong customers. You know, we say at Total Expert, win customers for life. And having that mindset throughout your organization will really dictate your strategy on how you're leveraging data, how you're putting the building blocks together.
Why is financial literacy so significant for your platform specifically?
So first of all, Total Expert was, our fundamental belief is that financial literacy and education as part of that customer journey is incredibly important. And so you think, why is that? Well, if you think about consumers that have a much better understanding of the financial decisions they're making, they're ultimately going to get better outcomes. And that's quite the opposite. If you remember back.
All right, well, I do want to bring in my colleague Trinity Chavez joining me on the floor. Trinity, so much to cover. What is the pulse on the floor right now as we see the stock market reacting to the downside?
Absolutely. And the word here on the floor, I've been speaking to some traders, is not very good news. Unfortunately, with the longshoreman strike happening, as well as the geopolitical turmoil that's unfolding overseas, traders are telling me that it might signal to the Fed not to drop interest rates. But of course, you know, we will see how the day plays out as we continue to monitor the markets throughout the day and see how we close the market today.
Yeah, I think that uncertainty between the strikes, we have the Boeing workers strike as well. Of course, tensions in the Middle East are really putting a damper on markets, but still near record highs. That jobs report is out tomorrow. For our viewers watching, we will have you covered wall to wall with the jobs report that comes out before the market open tomorrow. Trinity, I think we're going to leave it there. Trinity Chavez joining me from the floor of the stock exchange. We'll be following this REIT as well, FrontView REIT, which now trades here on the floor of the stock exchange, as long as Standard Aero, which debuted yesterday in the third biggest IPO this year. Trinity Chavez and Kristen Scholler here in studio. Thank you so much for watching.
Life, I'm reminded that it's not about the destination, it is truly about the journey.
My pleasure to greet you today from the center of the U.S. capital markets here at the New York Stock Exchange.
I want to just take a minute and not just talk to the people that are in the room, but I want to speak to the rest of the team around the globe. These are people that made this happen, and I know that there is no way we would be here if it wasn't for you.
Everyone at Flutter is proud to join such a distinguished list of companies on this great stock exchange.
Not many people get to do something big in this world, and we get to do something truly special.
This is such a wonderful place to both look back and look forward. Look how far we have come. I'm so optimistic about what lies ahead. It has been a privilege.